Welcome to Theo Trade. This is Don Kaufman. It's May 17th, 2023. Just about 35 minutes left inside of your trading day. The SPOO's up some 44 handles. We are ripping once again to the upside. People, it's all about, well, the stock market saviors, the Magnificent Seven defying market weakness. Look, we're going to break down intraday trade and some of the implications of, well, what have become effectively seven stocks that own today's marketplace. We're also going to break down some of the implications on a much longer time frame. Let's get to work here on this evening's video. As I was saying moments ago, SPOOs are running, so we're up 44 handles. I got to tell you though, I'm almost to the point of like pushing aside, like, whatever, man. The market's up 44 handles. The NASDAQ is up 158 handles. And the reason I'm kind of, whatever, pushing that aside is, hey, take a look right now, once again with me here at the 90-day 1 hour. This is something I bring up just incessantly on the weekend updates here, and to the point of nauseum. All right, let me reiterate one more time. Nothing counts until we actually break the range. Nothing counts until we break the range. So what at this point? Look, I'm just glad right now that we're not trading at 41.50. I mean, every day lately we've had a close right around 41.50. But hey, look, there's still what? There's still 30 some odd minutes left inside of the trading day. So no question, we could still very well end at 41.50. With that being said, so what? There's a bid back to the marketplace. Just because we're at the lower edge of the range, even if we got to 4,100 or we're the upper edge of the range, 42, 42.11, push all of it aside right now until you actually smash through that range with some conviction. It's all for nothing. It's all fodder at that point. And that's one thing that I really try to impress upon you, okay, with some of the day-to-day moves in here. Speaking of day-to-day moves, one of the things I also want to impress upon you is that, again, you've got a market now that I'm calling it, the Magnificent Seven. It's the monsters of tech. Okay, it includes Microsoft and Apple and Amazon and Nvidia and Tesla and Google and Meta. Oh my, right? So it's the same seven stocks we've been talking about, but one of the implications, and we're going to start with again intraday trade. You do have to recognize in this market right now that some of the market internals, like look, the advanced decline line today, it's not exactly stellar. It's not exactly stellar, but in theory, you could actually have, and again, as I say, I really want to impress this upon you because it's so critical to understanding that, at times you have to change, okay, where the market is going to eat you alive. And when I say you have to change, there's been major structural shifts in here. You could technically have 90 stocks declining, okay, 10 stocks to the upside. But if any of those 10 stocks are, some of this, what I term the Magnificent Seven over here, you can actually have the S&Ps up and up substantially, okay? Point being is market internals are going to be less favorable right now. And I'm not just talking about an advanced decline line, all right? When you have Apple effectively worth more than the entire Russell, you got a lot of problems, people, okay? And I'm going to further this. If you're taking a look, for instance, at ticks, a lot of people like to use ticks. So do I. I mean, I built Quantix, right? So Quantix and comparative ticks, right? This is comparative tick analysis. And if you take a look at the comparative tick analysis, what good is it when, again, if order flow shifts expressly inside of something like Apple, or order flow picks up to the upside inside of Tesla, okay? Your ticks are worthless. I mean, in theory, you could be riding on a negative 1,000 tick. And for those of you that have no idea what a negative 1,000 tick is, it implies sell side activity. I mean, expressly maybe in the New York Stock Exchange, but it implies sell side activity, okay, in markets. But does that really matter when the market cap, if you will, of a Tesla, okay, is bid? And the answer is no. Nothing makes a difference right now in terms of market internals. You can look at breadth. You can look at everything you want. But if Tesla or Nvidia catch a bid, it's over. Like today is so unique. And I love talking about this today because Apple is massively unchanged. Apple, ironically, has been massively unchanged. Now, I was actually mentioning this in the weekend update that Apple has been relatively unchanged. Microsoft even, it has slowed down. It's up today and maybe breaking outside of this range over here, but it's definitely slowed down the upside potential over there. Meanwhile, Nvidia is actually breaking out a bit to the upside. Earnings though coming up, okay, in the very near future. It's going to make things, that's next week, but it's going to make things that much more entertaining for this marketplace, okay? But effectively, what do you got? You got a handful of stocks now that are actually driving the entire market. As I said, market internals. You have to rely, again, you have to kind of like downshift and rely less on some of the market internals for those of you that are trading on an intraday basis. And you're going to have on your screen, okay, literally, these 7 stocks. And if you don't, okay, that is your market internal right now. And to further this picture, and I was talking about this again on the weekend update, and I'll reiterate it right now. Like, for example, you go over to the financials, and I think everybody's familiar with the financials, one of the biggest sectors out there. Year-to-date basis, they're down about 5%. The energy sector, down about 7%. So those are your 2 very, very large sectors. And you look at this and you go, wow, I get it. Okay, so 2 sectors are actually down. And then you, of course, have the NASDAQ, and the NASDAQ is up some 25%. Okay, we've had one of the largest divergences of NASDAQ, okay, versus, for example, S&Ps. Bring up the S&Ps, they're only up about 9%. But here's the one that was really striking to me. Take a look at the Dow. You realize that the Dow is actually unchanged. So it's the largest divergence on a percentage basis since 1991 between Dow, okay, and effectively, NASDAQ. And again, you go back to, do we even want to count that when it's all the way back until like the 1990s? But it's some of the largest divergences that have ever actually been seen. And if you look at the Dow, you go, well, the Dow is just not performing. No, the Dow is actually, okay, not market cap weighted. The Dow is about price, okay, and price action within a given stock. It's not market capitalization. That means that, yeah, Apple is inside of the Dow, but Apple is not exactly going to do anything because it's minute inside of the Dow. And again, come over here and take a look at this quotes. What matters the most inside of the Dow is going to be United Healthcare. Not because it's market cap, but because, again, price is nearing $500. Next on the list is stuff like Goldman Sachs. Microsoft is up there, okay, but it's just not going to have the implications. Market cap does not matter. So with that being said, again, people are a little shocked to find out that, again, on a year-to-date basis, Microsoft might be up 30%. Meanwhile, the Dow, okay, the Dow itself, massively unchanged. Moreover, if you take a look at the Russell, clearly the Russell has had a drastic, drag because of the regional bank crisis. Also, many energy stocks in here. The Russell is also massively unchanged on the year. So where do we actually go with this knowledge? 7 stocks basically running the marketplace at present time. We see the marketplace literally fractured into 2 kind of subsections of, well, 7 stocks that perform, and then there is everything else. At a time like this, you have to be extraordinarily careful, not because that there's just 7 stocks in here, and obviously, okay, any one of those 7 stocks, in this particular case, of course, we're looking over at Microsoft, which is threatening to the upside. At any point, any one of these 7 stocks could actually decimate this marketplace. On the flip side, though, and there is actually a very positive side of this, what if retail traders are to come in and continually push gamma squeezes, okay, into a Microsoft, into an Apple, an Amazon, a Google, a Meta, a Tesla, an Nvidia, effectively going out and buying calls and actually forcing these stocks higher through hedging activity, okay? There are some very, very wild implications based on this significant, again, if you will, divergence of what we term mega market cap and everything else in the market. I can tell you one of the results of this is, looking at the marketplace lately, which has been in an incredibly tight range, obviously from 4,100 to 4,200. And there's nothing more to say about the market today. Who cares that we're up 42 handles right now? Doesn't make a difference. We're still in the exact same range. But one thing that's really resonating with me, okay, VIX still looks high relative to the fact we're in a 100-point range. Skew has really picked up lately relative to, again, an incredibly tight range. Even the VVIX, which is down today, even VVIX, though, picked its head up off the mat. I mean, people, the one thing that really should resonate with you at a time like this is even if the range inside of the S&Ps is completely binary. And by that, I simply mean like, look, when we break this range, there's going to be some violence in trade. I think we all understand that, and you got to have some respect for it. Meanwhile, though, okay, the risks are just growing substantially, not because we're just in a range, but because 7 stocks ultimately are holding, okay, on to everything that you see in this marketplace. That 7 stocks, okay, along with these gamma squeezes, if you will, to the upside, okay, are all that we have that stands between us, if you will, and a degree of the abyss in this marketplace. With that, one of the last things, of course, I love to cover here on every Wednesday night is taking a look, of course, at expected move in the SPX. So the SPX today is up some 43 handles. Where does that take us on the week? One of the most important things that I can express to you, okay, is that on a week-to-week basis, markets really, okay, adhered to the expected move. Now, this week, what are we looking at? Oh, approximately a $63, okay, and 85-cent, okay, expected move. Now, that's the weekly expected move, meaning you're looking for about a $64 move to the upside or a $64 move to the downside. What are we actually seeing at present time right now? And that's again where I look at the S&Ps and I'm like, oh, they're up, 43. Look, people, it means absolutely nothing. It's good for nothing. We're not even but halfway home to the upper edge of the expected move, which again brings us to this. All right, the remainder of the week anticipates some movement. All right, we're 7 weeks into the exact same range. Be rather constrained. There's no question about it. There's a lot of risk on the table right now. There's a lot of stake on the table right now. Push aside, okay, the ideals, if you will, of any concerns about debt ceiling, okay, push it aside. Trade what you see in front of you. Be careful of market internals, okay, and watch volatility. Sure, volatility has come down, and that's just a function of a little bit of a rally today. But ultimately, all right, volatility is relatively high given the fact there's only been a 100-point range inside of the S&Ps. That on a day-to-day basis over the last few days, okay, those ranges have been absolutely minuscule. And yet, okay, we're still in almost a 17 VIX. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.